Bonds. There you go. You can read it. I don't have to read it to you. What a bond is a loan. Okay. Like people get nervous about them because it sounds like something different, but it's a loan. But it's usually a special loan in the sense that they're often quite long term, like 30 years or 15 years, but they can be shorter. You can have like a 1 year bond. And all a bond is like a loan sourced from multiple lenders. So what happens is, let's say Carter wants to start, let's say he's already got a company and he wants to like build a brand new building and it's going to cost him $20 million and he doesn't have $20 million, but he has the capacity to repay that $20 million. So he could just go to a bank and a bank might loan him $20 million, but not always. So another thing he can do is he can go to an investment company, someone like Edward Jones or Merrill Lynch or some other big. Merrill Lynch is dated. They were bought out by, they're still called Merrill Lynch, but they were bought out by Bank of America. Um, and in essence, he can have them structure a bond. And what they'll do is they'll in essence make a loan of $20 million, and then they'll sell little chunks of that loan off to a bunch of investors. Like maybe I would like to invest in his building, but I don't have $20 million, but I have $5,000. So I can buy $5,000 of that bond. So you get a whole bunch of people willing to loan money. They each loan small amounts in, and then the bond holding company has that structured so that he gets the $20 million. And then as he makes payments, the interest goes out to people according to the amount that they lent. Okay. So it's a little weird. For this class, and from the perspective of like, if you are a bond holder, if you're, if you're the person who purchased the bond, um, then all you're doing is you have this bond receivable where you put in $5,000, you're going to get interest on it, and then at the end of its term, or they call it its maturity, you'll get your $5,000 back. So it's just like lending money. If you're the company that's issuing the bond, then all you're doing is you got $5 million, or you got, what was it, $20 million now. You pay interest on it the whole time, and then when it comes mature or due, you pay it back. So it always like freaks people out because it feels different. But from the perspective of the business, yes, there's all this weird packaging of lots of people and buying into the bond. But from the perspective of the business, it's the same. I borrowed 20 million, I paid interest on it, and then I paid it back. So that's all a bond really is. Okay. There's three main types of bonds. There's corporate bonds. That's where a corporation is the one issuing the bond or borrowing the money. There's government bonds. That's where the federal government is the one borrowing the money. And then there is municipal bonds, where municipal governments like school districts or cities or airport authorities, they're the ones issuing the bonds. Okay. So that's what a bond is. It's just borrowing money. The difference is you may be borrowing it from many sources, but from your perspective, it's going to be the same. You're borrowing it and then paying it back. Couple terms or concepts of bonds. So the face amount of the bond, meaning the amount that we are borrowing, is sometimes called the principal, which we've used that for other loan terminology. Um, like I said, a bond issue is normally divided into a number of individual bonds. Um, let's see, anything else we really need off of this page? Not really. We'll get to the other concepts as we go. All right. Here's where bonds are a little different than other loans. So I just did all this talking to tell you how they're the same as other loans. But what's different about them is they're marketable. Meaning, if I'm a bond holder, I invest $10,000 into his building, okay? And then I decide I need the money. I need this $10,000 for some other project. I could sell those bonds to another person. So they're tradable. Okay. I can, and what can I sell them for? Well, I mean, I could sell them for whatever I can get, just like any other asset I own, right? If I have a, if I have a thing that I paid 10,000 for and someone's willing to pay me 11,000, I can do that, right? I'm allowed to do that. But usually bonds that are traded on the market, so bonds that are issued by big companies or issued by the government, there's a market. People are constantly buying and selling them, and so a market price sort of evolves out of that, right? Anybody who's taken economics, you probably learned a little bit about market pricing, which really is you just have a group of buyers willing to buy something and a group of sellers willing to sell them, and they negotiate and haggle until sort of an equilibrium price forms. This is what I'm willing to sell for. This is what people are willing to buy for. So the market price is going to affect what you could buy or sell a bond for. The other thing that's interesting is when we issue a bond, we don't always borrow all of the money at that time. Okay. So if I need $20 million to build a building, I probably don't need all 20 million of it sitting in cash in my bank account for the entire project. I might issue 5 million up front, and that'll be enough to buy the materials and hire the company, and they'll start working on it. And then, 3 months into the project, I'll issue another 5 million, and that'll be enough to make payments as we go. So bonds get approved at one rate, meaning an interest rate that we're going to be paying, and a face value, but then we actually will issue those out sometimes in multiple chunks, depending on how we need the money. Okay. Why pay interest on the whole thing and on the whole 20 million if you can wait 6 months before you have to issue another? That would save you 6 months worth of interest. 6 months of interest on $20 million at 5%. That's a lot of money, right? All right. So those are things we need to understand basically about bonds. So here's the thing. Like I said, bonds have a face value, the amount you're borrowing, but then we can issue it in chunks. They also have a face rate. This is the rate that the bond guarantees it will pay interest at. Okay. And then in addition to these two things, there's this other thing out there that's not part of the bond, but it's part of the broader market, which is the market rate of interest. And the market rate of interest fluctuates. So the face rate on the bond usually is set at the market rate at the time the bond issue was written up. It's like a big bunch of paperwork to draw up this whole agreement, right? Between the company that's going to borrow the money, the company that's going to facilitate the lending from all the different lenders who are going to do it. And so they'll draw it all up, they'll set a rate, and then that market rate of interest will fluctuate as it does, because that's just a market saying, here's how much I'm willing to lend money for at a given moment in time. So if we issue our bonds at a time when our face rate, or sometimes it's called the contract rate, is the same as our market rate, then we'll be selling our bonds at their face amount. Meaning, a person who's buying $10,000 worth of bonds, that's the amount printed on the bond, will pay $10,000 for it. Makes sense. Here's where it gets a little confusing. If the market rate is greater than the contract rate, so things change in the lending market and the market rate of the bond goes up, let's just say to 6%. Sorry, not the market rate of the bond, just the market interest rate, meaning now lenders are not willing to lend their money unless they can earn 6% on their money. Then what will happen is a person buying into the bond at that point will not want to pay full face value for that bond, because there's new bonds coming out that are paying 6%. Bonds are constantly being issued by lots of companies. So if the interest rate fluctuates up, buyers will not want to pay full price. So we'll have to sell our bond at a discount, meaning for less than the face value. The reason for this is if somebody will buy the bond, let's say we're going to issue $10,000 of this $20 million bond. If somebody can buy the bond for $9,000, but then they earn interest on the whole $10,000 face amount of the bond, and when the bond comes mature, they get 10,000 back. It was like they earned 6% interest because they were able to buy the bond at a discount and then get back the full face amount when the bond came mature. Okay. Or if the market rate is less than the contract or face rate, so now interest rates fluctuate down, and now the best we can get on new bonds coming out is 4%. Everybody really wants the 5% bond because it's paying more than what the new bonds coming out are. And so they'll be sold at a premium. So now to buy $10,000 worth of that bond, you may have to pay $11,000. You'll earn 5% interest on the 10,000 and you'll get 10,000 back. And in essence, it'll be the same as if like you were earning 4% all along. This is confusing for everybody at first. Okay. When I was studying to get my securities license, the bond thing broke my brain for like 2 weeks until and then I started like understanding them, and I sold a lot of bonds when I was doing it because I actually like them, especially for older people. Right now, it's hard to remember the why, but at least try to remember the what. And the what is, and we'll see it when we get into some problems, okay? The what is when market interest rates go up, bond prices go down. So there's like this opposite relationship between them, meaning if interest rates go up, then bonds will be issued at a discount to their face value or less than what their face value is. If interest rates go down, then bonds will be issued at a premium or at an amount greater than what their face value is. It doesn't make a lot of sense yet. We'll do some examples and it'll make more sense, but try to remember that fact out of all of this I just explained. Interest rates up, bond prices down. Okay. Opposite relationship between market interest rate and bond prices. Clear as mud. All right, so let's take a look at one and see if it makes some sense. Okay, so this one's, let's just look at it. On January 22nd, Jefferson County Rocks, Inc., a marble contractor. I'm thinking they sell like marble countertops, not marbles, but maybe. They issued cash. Oh, they issued for cash 210,000. What the heck? I'm on the wrong one. I was like, this is weird. Sorry, I went to chapter 12. Everybody's like, that one does not match mine, right? Let me go 11. Bad teacher. Makes awkward jokes. Clicks on the wrong thing. Tells us to remember who we are. It's just weird. All right. Does this look more like it? Yes. All right. So here we have United States Steel Corporation's 7.5% bonds due in 2022 were reported as selling for 103.2. All right, so this is another point of, I guess, just how bonds are, how they're talked about. When we say a bond is selling for 103.2, what that means is 103.2% of its face value. So you'll see them like a bond selling at 99 means a bond is selling at 99% of its face value. Another term we would call that at a discount because it's less than its face value. A bond selling at 100 is a bond selling at its face value. Sometimes they'll say it's selling at par. That's another word they'll use. If you're a golfer, you know what that means. That's like It's not really average. You got to be pretty good to golf par. It's more like the expected value for that given hole for someone who's good, right? So for this, it just means it's selling at its face value. And then if it's selling at a number greater than 100, then that's called selling it at a premium, at above its face value. So we have bonds selling at 103.2. So first question, were the bonds selling at a premium or a discount? If it's above 100, premium. Okay. And why is United States Steel able to sell its bonds at this price? Why do you think they're able to sell their bonds at for more than its face value? So this means if they were going to sell $1 million worth of these bonds, they would get 3.2% more than $1 million. They'd get more cash than they would. Okay. It says because the market rate of interest for similar quality bonds was blank than 7.5, was less than. So because the market interest rate dropped, the value or price of the bonds went up. Again, if you can't remember all the rules and it seems confusing, just remember that opposite relation between market interest rate and the price of bonds. So these bonds are selling at a premium. That's any amount over 100 because 100 means 100% of its face value. So here, this means 103.2% of its face value. So just to explain this a little more, if we had $1 million bond and it was selling at 103.2, I would just multiply it by 103.2, and that would tell us how much cash we would get. Ooh, sorry. Million. What is that noise? Times 1.032. That's 103%. So when we issue that bond, we're going to actually get $1,032,000 in cash. We're going to pay interest on $1 million because that's the face amount of the bond. And then when we pay the bond back at the end of its useful life, we'll only have to pay back $1 million. So that $32,000 is extra money we're getting because the bond is trading at a premium. And effectively what that does is it reduces our interest rate, right? Because we don't have to pay as much to borrow that money. So that's what's happening. All right. So the bonds are selling at a premium because the market rate of interest for similar quality bonds was blank, lower than 7.5. The bonds at a premium, that means that if people are looking to buy bonds, they're not going to find as good a deal as yours, so they're paying extra for yours. All right. So like I said, if the market rate of interest is equal to the contract rate of interest, the bond will sell for their face amount or at a price of 100 or at what we call par. So this says assume on January 1st, 2025, Eastern Montana Communications Inc. issued the following bonds. Face value, $100,000. Contract rate of interest, 12%. That contract rate is sometimes you'll also see it called the face rate. That's the amount that's on the written bond agreement, okay? Interest is paid semi-annually, June 30th and December 31st. The term of the bonds is 5 years, and the market rate of interest is 12%. So when the market rate equals the contract rate or face rate, that means we're going to issue those at par, meaning 100,000 of bonds will sell for $100,000. Okay. So the journal entry will just look like this. After all of that information, it's as simple as cash goes up, bonds payable goes up. Remember, bonds payable is a liability, so it will increase with a credit, right? And cash is an asset, of course. So we have to kind of have all this knowledge of how they work, but then like it really is the journal entry is that simple. We borrowed money, cash went up and the payable went up. Then every 6 months, the bond pays interest. What's the journal entry for the interest? Well, it's the principal times the rate times the time. Okay. For the principal, we always use the face amount of the bond. So 100,000, the rate is 12%. And since the bond pays interest twice a year, then the interest is all, or then the time is always 1/2, right? So principal times rate times time looks like that. And then our journal entry is just a debit to interest expense and a credit to cash. The reason I like selling these investments, especially to older people, is if you can get a company that's very secure, or like the federal government, who's very secure, has always, the United States has never not made a debt payment. We'll see if the government stays shut down, how that keeps going. But to this point, they've never missed a debt payment. So they're very secure. And so for an older person to be like, oh, I'll put in $100,000 and I'll get $6,000 a year in like interest, that's pretty much guaranteed. That's pretty good, right? That's what they're looking for. They're not looking for the volatility of investing in the stock market. They like consistent returns. All right. So that's all the journal entry is from our, if we're the issuer, as we have an expense and cash. Then at maturity, meaning when the bond comes due, we're going to debit the bonds payable account to get rid of it and credit cash to pay that off. So it really is a true loan in that sense. We get cash, we pay interest for the term, right? If the most bonds pay semi-annual interest or twice a year interest. So in essence, they got $100,000. They paid $6,000 every 6 months for 5 years. And then at the end of 5 years, they paid back the 100,000. They got the use of that money and had to pay interest on it. Okay. So that's all when we issue a bond at a face amount. So let's take a look at the second one here. So Thomson Company introduces and distributes semiconductors for use by computer manufacturers. Thomson issues $800,000 of a 10-year, 6% bond on May 1st of the current year at face value, with interest payable May 1st and November 1st. The fiscal year of the company is the calendar year. So it wants us to do an entry to issue the bonds at their face amount. So it really is as easy as being like, when we issue a bond, our cash goes up because we're borrowing money, and our bond payable goes up. And since it's the face amount, they issued 800,000. So it really is that simple. November 1st, they pay their first 6 months of interest. So principal times rate times time, or 800,000, which is the principal, times the rate of 6% times the time of 1/2, right? Or 6/12, because it's half a year, but we just do 1/2. So 800,000 times my rate times my time, which is 1/2, or I can do, if it's less confusing, I can do times 6 divided by 12, because it's for 6 months. $24,000. So we'll debit interest expense. We'll credit cash because we're paying that cash out. Now, here's something tricky that I didn't introduce before, which is the first example bonds we looked at, they paid interest perfectly on like June 30th and December 31st. So there was never this situation where we had to accrue the expense of the bond interest into the next year. So we're back to adjusting entries again. In this case, though, if we paid interest on November 1st, then by the time December 31st comes, we've accrued more interest expense, right? We're not going to pay it till the next interest payment. So at the end of each year, we're going to have to recognize any expense we've accrued up until that moment, up until that. So if we paid interest on November 1st, then how many months worth of interest have we accrued by December 31st? Dose, right? All of November and December. Now we're not actually paying it yet, but we have to recognize we've incurred this interest expense so it can go on our income statement at the end of the year, okay? So we have to do these adjusting entries at the end of each year to show interest expense and interest payable. And again, we paid on November 1st. So at December 31st, we're going to have all of November's and all of December's, or 2 months worth of interest that we have to recognize as an expense for that calendar year. So we go 800,000 principal times rate, which was 6%, times time, which is 2 months out of 12, right? So times 2 divided by 12. That gives me $8,000 worth of interest expense. Nice. Whoa. We're halfway there. Got a 50%. All right. And we're living on a prayer. Both of those two things. You guys are lively today. Like, no, your jokes just suck. All right. Can you say suck in the classroom? Or does that feel like it's just way too unprofessional? I'm surprised how many people nowadays I'm seeing willing to say suck, like from the pulpit in church, like as part of their talks and stuff. I'm like, never thought people would say suck in church. My grandmother thought it was a bad word. And when I said that sucks, my grandma would be like, she wouldn't smack me, but you could tell she was getting itchy fingers to just smack me in the face. So of course, as a teenager, I tried to find as many reasons as I could to say suck or sucks in front of my grandma. We need to do better, people. Let's do better for our grannies. All right. Um, all right. So let's look at maybe now you guys are the age where your grandparents might say that sucks. So there you go. My grandkids are at the age where their grandpa says that sucks. All right. All right. So we have bonds issued at a discount. So assume on January 1st, 2021, Western Wyoming Distribution Inc. issued the following bonds. Face amount 100,000. Contract rate of interest 12%. The term of the bonds is 5 year, and now we have a market rate of interest of 13%. So your brain should be saying if the market rate of interest is higher than the contract rate, then that's going to drive the price of the bonds down because it's an opposite relationship. Market interest rate higher than the contract rate, then we're going to be issuing these at a discount. And the hope is you get to where that you understand that without the big bold words saying issued at a discount up above it, which helps, right? So we'll be issuing these at a discount. All right. So here we have, because the contract rate of interest is less than the market rate of interest, bonds will sell at their face amount. See, I think that's confusing. I would like it if they said, because the market rate of interest is greater than the contract rate. That helps us remember. Market rate goes up, price of bonds goes down. Okay. So they tell us the bonds will sell for $96,406. So what we do then is we create this journal entry that shows we received this much cash, but we're borrowing this much. The difference between that is called the discount on the bonds payable. So we are getting 96,406, but we're going to have to pay back 100,000 when the bond comes mature. And we're going to pay interest on the full face value of 100,000. So that means that the bond, if we're the borrower or the issuer of the bond, same term, okay, that we're going to be paying more cost for the borrowing that money, meaning our effective interest rate that we're having to pay is going up. So this is what it looks like when we issue a bond at a discount. Our cash will be less than the bond payable, and the difference will be a discount on bond payable. All right, to add more confusion. Just like when we do like things like depreciation and stuff like that, we try to recognize that cost of using the asset over time. Well, we do the same thing with bond discounts and bond premiums. We have to recognize that bond discount means we're paying more money to borrow the money, and we want to recognize that discount as an expense spread out across the bond's life. Okay. So the term is called amortization, which is a fancy sounding word, which just means to spread something out across the lifetime of whatever it is that you're dealing with. So what happens is each time we pay our interest on a bond, we're going to recognize a portion of that discount as being amortized or used up. And that's actually going to, in the case of a discount, increase our interest expense. How do we do it? We just take the amount of discount and we divide it by the number of interest payments in the bond's life. Bonds pay interest how often? Twice a year. So if a bond has a 5-year life, it has 10 interest payment periods in its life, or it's going to make 10 interest payments to each year. So we would just take the total amount of that discount, divide it by 10, and then recognize each time we pay interest, 1/10 of that discount is used up, add it to the amount of cash interest we're paying, and that'll be the total interest expense. Okay. Once you get the hang of it, it's not hard. But at first, you're like, this is a lot of little stuff to remember. Does that seem like what this class is all about? Let me just barf out a million little things for you to remember, and then you have to apply them on a problem. And then you have to take a test and apply them again. So for Western Wyoming's distribution, Western Wyoming Distribution's bond, they had a discount of 3,000, or sorry, they had a discount of $3,594. Since the bond is 5 years, we would say how many semi-annual periods are in 5 years, which is 5 times 2, 10. Divide that total discount by 10, and that gives us the amount to do for amortization. So then when we do our interest entries, we're going to have the amount of the discount that was amortized plus the amount of interest payment, and those are cash payment for interest, and those two together give us our interest expense. That's the real cost of borrowing that money, is the $6,000 in interest we're going to have to pay plus the $359.40 every 6 months worth of discount we're going to have to recognize as part of the cost of borrowing that money. All right, so let's do an example question. All right, on the first day of its fiscal year, Chin Company, the Crimson Chin, is issued $10 million 5-year 7% bonds to finance its operations in production and selling home improvement products. Interest is paid semi-annually. The bonds were issued at a market interest rate of 8%, resulting in Chin receiving $9,594,415 in cash. So this is a discount situation, right? They're getting less cash than what the bond payable is. So we're going to debit cash, $9,594,415. We're going to debit some amount to discount on bonds payable, and then we're going to credit bonds payable. Bonds payable is always the face amount, so 10 million. So the discount is just the difference, right, between what we borrowed, 10 million, and the amount of cash we actually got. So their discount was $405,585. All right. Second, we're going to do the first semi-annual interest payment. Let's see. So it looks like these ones. So what we have to do to figure out our interest payment is we know, I always like try to start with what I know. I know we're going to be paying cash. I know we're going to have an interest expense and that we're going to recognize some amount of the discount being amortized. Okay. So to figure out the amount of cash, we just go with the face value. That's our principal times our rate, which was not the market rate, but with the rate of the bond. Okay. Times time. So I have the principal of 10 million times the rate of 7% times my time, which is 6 months out of 12. So we're going to pay $350,000 in cash interest. So our cash will go down by 350,000. And then for our discount, we're going to take the amount of this discount right here and divide it by the number of semi-annual interest periods. So if it's a 5-year bond, it'll have how many? 10 semi-annual interest periods, right? So we'll just take 405, whoops, 585 divided by 10. And that's the amount of discount we're going to recognize or amortize each period. And it tells us here the bond discount round to the nearest dollar. So I'm going to do 40,559. And the interest expense will be just those two added up. 390,559. Whoops. So if you think about what this is saying from an accounting perspective, is it's costing us $390,559 every 6 months for interest expense. 350,000 of that comes from the actual interest we're paying to the borrowers. The lenders. And the other 40,559 comes from the fact that we issued it at a discount. So we're having to make up the difference between the fact that we only got 9,594,000, but we have to pay back 10 million. Sorry. So we're recognizing that difference between what we got and what we have to pay back as an expense, but we're spreading it out over all 10 of the interest payments. So that's what's happening here. So then we have the second semi-annual interest payment. And so it's going to look just like this first one, since we don't know, since we're assuming it's a full semi-annual interest payment. So we're going to do the same thing, interest expense, the discount on bonds payable, and the cash. And the numbers are even going to be the same, right? Because we're going to be paying 350,000 in regular interest. We're going to be amortizing another 40,559 in bond discount. And the two of them together will add up to the total amount of interest expense. So then it says determine the amount of bond interest expense for the year. Well, we did 390,559 for the first semi-annual payment and $390,559 for the second semi-annual interest payment. So it's just, that's how much interest we paid or have as an expense this year. $781,118. It's a lot of money. That might get you guys a small house nowadays. Why was the company able to issue bonds for only $9,594,415 rather than for the face amount of 10 million? So why would they accept this situation where they're getting less than what they're going to have to pay back? What would force us into a situation where the bond price was less than the face price? Yeah, because the market rate went up. Yeah. And this happens. You draw up the bond, everybody agrees to it, and then the market interest rate fluctuates before you actually issue all of the bonds. Okay. So the market rate of interest is higher, greater than the contract rate of interest. Therefore, this says inventors. I think it should be investors are not willing to pay the full face amount of the bonds. There we go. So there's an introduction to bonds. And yeah, I know like the last chapter felt a little easier. There's only like one, maybe two that were kind of tough on the homework. The others were pretty smooth, I think, for most of you. And so this gets us back into some stuff that's a little harder. But I promise you, this is the kind of thing that for most of you, it'll like click at one point and you'll be like, oh, I think I was making this harder in my head than it was. Um, you know, when in doubt, if your journal entry will balance, you'll be okay, right? You just have to know which accounts you're dealing with. All right, so that's all I have for you today. 2 minutes of your life back. It doesn't make up for the 5 and 10 minutes I've gone over a couple times in the past, but trying. Have a great day. Remember who you are. Make good choices.